So sitting in first class here in Singapore Airlines, I thought it was a good time to talk about my 7 points on wealth. There's loads of kind of gurus and people that go on about wealth management and wealth creation, and sometimes when I listen to their presentations or watch their YouTube videos, they're so like hopelessly flawed. I genuinely think they probably haven't created any wealth of their own. So I'm going to give you my kind of 7 key things I think to take on board to help you. The first one is just a simple business principle, which is everything measured improves. So the metric that you choose to measure in business tends to be the thing that gets better. I guess a bit like, if you're weighing yourself every day, then your weight tends to go down. So loads of people have wealth as a goal, but then they don't measure their wealth. So they focus on other things like growing their business or getting more sales in or a whole bunch of other things. So the first thing you need to do is create a personal balance sheet. So just make a list of all of your investments, all of your assets. Exclude your home and your business, because your business could go bust any minute now, and then see how long your home is still your home. But your investments outside of your home or your business, so buy-to-let property, stocks, bonds, REITs, all of those kind of things. And then make a point of measuring it on a regular basis, because if you check it, weekly, monthly, deploy more capital into assets, then you'll grow that balance sheet over time, and you can set yourself reasonable goals around that wealth creation. So then the second thing is to then focus on capital events. So I think far too many people try and work on this basis of saving 10% or 15% of what they earn. You're never really going to get rich saving. You need to create capital events, and the easiest capital events to create is the sale of a business, whether that's a business you start and you grow and then exit, or whether that's a business you buy and then sell. Because these capital events, basically when you have a capital event, you can deploy all of that capital into income generating assets, and then that income can basically provide your day-to-day funds, and you're not relying on your income for investment. So then number 3, which kind of relates to number 2, is that you want to create a core portfolio, and the core portfolio basically generates all of your income. So very simply, make a list of everything that you spend money on a monthly basis. What is your kind of break-even position as a human, and then you want to create a core portfolio that basically covers that level of income. So if you need 120,000 a year to survive, you need to deploy enough capital to generate 120,000 of passive income. What this then means is you can really start to grow your wealth exponentially. So then number 4, again linked to that core portfolio, is once you have a core portfolio that's generating your income, you can now invest 100% of your income. So you hear all these people that say, oh, if you save 15% or 10%, or you have 10% in a rainy day fund and another 10% in a less rainy day fund or something like that. I don't really see how that's going to be scalable or how you can really create a lot of wealth. However, if you have your income for your day-to-day expenses coming from your investments, you can deploy 100% of your income into further growth. This is when your wealth then starts to snowball up. You get this really big kind of rolling up of your wealth. So then number 5 is to make sure you're well diversified. So I see so many people that understand, say, buy-to-let property. So they buy one, then they buy another, then they buy 20, 30, 40, 50, and they end up being 100% exposed to buy-to-let property. So if you have a major interest rate rise or a property crash, you're extremely exposed to this. In fact, I've seen many friends have terrible troubles when we've gone through different economic crises or property problems over the last sort of 20 years. So property's great. It should be a part of your portfolio, not all of your portfolio. And remember, buy-to-let property actually isn't really an investment, it's a business. You have customers, you have to fix boilers and do things. So it's more of a property business than it is a property investment. If you really want passive income from property, then something like real estate investment trusts are a much better way to achieve that. So number 6, leverage is okay if you use it to enhance your income to get to your income goals. So you often hear me talk about buying businesses where I hate leverage. I don't like using leverage to buy businesses. That's because businesses tend to be very high risk when it comes to the deployment of capital. So you don't really want to be borrowing money and then taking a huge risk with the money you borrowed. It's like taking out a loan and going to the casino. Now, I know lots of people have confidence in their own abilities around business, but in reality that can often play out not to be that well replaced. However, if you're growing a core portfolio of well-diversified investable assets, so stocks and bonds and REITs and things like that, using a bit of leverage to enhance the income in the first place can be a really great way of getting the income that you need to pay all of your expenses. That allows you to invest 100% of the current income that you're making and thereby bring down the amount of leverage you have over a short period of time. So leverage up a little bit in the short term and then bring it down in the long term. I guess again, it's like buy-to-let property where you have a mortgage to enhance your yield, but your goal would be not to be over leveraged. You want to try and then unwind some of that mortgage exposure so that you allow for a few bumps in the road or some economic downturn so that it doesn't actually kill you. And then the final one, number 7, is you want to get on the private wealth banking ladder. So private wealth banks are normally in Singapore anyway, it's $10 million and up deposited. And they basically give you access to products and services that you can't get from normal banks. So you get much better return on your income. If you're investing in funds, the funds have a much lower cost ratio. In fact, most of the really big funds actually offer a special version of their fund with a lower cost ratio for wealthy clients. You also get the leverage at an incredibly low price. So if you're doing normal leverage through a retail bank, you might be paying 3 or 4% for your money, and you'll be restricted to only buying more of the same kind of crap that they've got to sell you. Whereas if you go through a private wealth bank, you'll be borrowing at 0.7% a year, and you can invest in a wide spectrum of products that give you much better opportunity for return and often better security over the long term. And so what's really interesting is that by using a little bit of leverage and going into large blue chip kind of opportunities, you can generate really significant amount of income. So I talked at the beginning of this about generating that 100 to 150 grand of personal income. Well, if you were to do that through a retail banking relationship, you might have to have a couple of million invested in order to provide that level of income. Through a private wealth bank, you might find that that number's closer to sort of 400,000 to 500,000 deployed. So it's a really, really big difference to be able to replace your income. So the goal should always be to get on the private wealth banking ladder, because after that, your growth in wealth can become exponential. And if you want to find more about private banking and things like that, then as part of the Harbour Club, we do a whole wealth section, and we also have a 3-part wealth course, which is in the app for Harbour Club. So you can go in, it's about, altogether it's just over an hour long, where we go through all the different products and services that you can invest in, how you can use leverage in a really smart way, how you can protect yourself from economic downturns, and create what we call asymmetric risk, which is where you cover your downside so that you only have the opportunity for upside. And we show you some great ideas how you can generate those double-digit returns on your capital employed, so that you can generate a really good income. So that's my 7 points on wealth. I hope you follow all of our stuff and look at the other things we talk about, particularly around the buying and selling of companies, how you can create those capital events, and look forward to seeing you at one of our events in the future.